Good morning, everyone, and thank you for joining us. My name is Joe Litchauer of Kepler Trust Intelligence, and today we'll be diving into the fascinating and at times complex world of China. In a moment, we'll be hearing from Zhang, an investment specialist at Baillie Gifford's China strategy. She'll be sharing her thoughts on some of the overlooked opportunities within China's domestic economy and why the team believe that the country's internal growth drivers remain underappreciated. For those of you new to our format, here's what to expect. We'll be hearing from Qian on the trust for around 30 minutes or so, and she'll give a good overview on that, but also the outlook for China. And then we'll be moving on to a Q&A session that will last around 15 minutes or so. So if you do have any burning questions you want answered, whether that's trust specific or whether it's on broader China landscape, please do drop them into the Q&A box in the bottom right hand of your screen, and we'll try to cover as many as we can. With that, it's my pleasure to welcome you, Qian. Over to you.
Thank you, Joe, and good morning, everyone, and thank you for joining us. Over the course of next 20 to 30 minutes or so, I hope to touch on a couple of key things, including the recent macro and market developments in China, the updates in the Baillie Gifford China Growth Trust portfolio, and what are the key transactions we have been doing. And also we will touch upon recent performance and share with you our outlook for the asset class going forward. Now to start with, and as a reminder, Baillie Gifford was appointed by the board back in September 2020 to manage the Vietnam Pacific Investment Trust. And then the board gave Baillie Gifford the mandate to refocus the trust away from Asia Pacific region and instead to focus it solely on the most important and arguably the most exciting market of the coming decades, which is China. Now, what are we trying to do in practice? The China Growth Trust aims to achieve long-term capital appreciation and index outperformance by investment in the best growth companies in China. We focus on finding Chinese companies that can grow their earnings at a faster rate than the market over a time horizon of 5 years or even longer. We aim to buy them when we believe them to be attractively valued and then hold them in size. Indeed, it is our stock selection that has been the most consistent source of our performance over a longer period of times from a strategy level. Our research effort across our teams in both Edinburgh, where Baillie Gifford headquarters is, and our Shanghai local office is singularly focused on finding these fast-growing companies. If I can move to the next page, when looking at investment in China, China's investors in China don't always have the luxury of ignoring the macro factors. In fact, the macro headwinds in China have weighed on its equity market in recent years. The domestic economy has been weak at the aggregate level, with the property sector in particular has impacted growth levels. And the regulatory backdrop has been quite volatile as well. That has been impacting the market too. Geopolitical risk has undoubtedly increased over the past several years. And under this background, it has led to 3 years of negative performance in China's equity market from 2021 to 2023. However, since last year, market has saw a significant rebound. The trust itself has delivered very strong positive absolute performance and also has outperformed the index. So what has changed? Now, a key inflection point here was China's domestic policy stance. We have witnessed a decisive shift since September 2024. The government unveiled a comprehensive economic package to stabilize key sectors, including properties, and try to reignite growth. This is after a few years of very cautious policy making, and is perhaps the most aggressive fiscal move we've ever seen since the global financial crisis. Now, uncertainties around Trump's trade policy will likely to further reinforce Beijing's domestically focused instance. So why is this policy shift significant? Well, global markets have largely focused on the US-China trade war, while our interactions with Chinese companies suggest that the China's business community views President Xi's domestic economic policy agenda is much more important. Domestic policy matters more for Chinese business, and in this context, it's worth noting that more than 80% of the trust portfolio's holding revenues comes from domestically from China. So in conclusion, 2 out of the 3 major headwinds we faced in the past several years have either abated or turned to more tailwinds. Geopolitics, however, remains a quite complex mix. China's role in the world is changing. In 2000, China was the largest trade partner for only 30 countries in the world. Today, China is the largest trading partner for 140 countries. This will inevitably lead to competitions with other trading powerhouses historically, as well as frictions with other countries' domestic interest. For Chinese companies, tariff uncertainties aren't new. Chinese companies have spent the past 7 years since the first trade war in diversifying their supply chain and expanding to new markets. While higher barriers of accessing to US market isn't good news, we acknowledge that in aggregate, China and Chinese companies are better equipped to deal with the trade wars than 7 years ago. Listed Chinese companies now earn more revenue from selling to emerging markets than developed markets. Exports to the US have since fallen to less than 3% of China's GDP. This again comes back to the argument that we mentioned at the beginning. Domestic policy and activities matters more. In the environment with external uncertainties on trades and also technology restrictions, China will continue to focus on domestic activities and technology self-sufficiency. The Chinese economy is experiencing a quite large-scale transition, where new growth drivers are replacing the old. China now accounts for nearly 1/3 of global manufacturing output. It is leading the world in electric vehicles, industrial automation, and increasingly artificial intelligence. Consumer activity is also picking up, slowly but steadily. Now, consumers in China are still cautious, but we are seeing very early signs of recovery, especially experience-based consumption. For example, Haidilao, one of the restaurant chains we invested in, is seeing strong foot traffic. Luckin Coffee is the largest coffee shop in China, is expanding rapidly, and Meituan, the food delivery services, is in very high demand again. Now, Chinese households have saved an extra of almost $11 trillion in household savings. That is almost 3 times of UK GDP since the pandemic. This is a very large cash pile that could potentially spur consumption. Now, the key challenge in recent years have been a lack of confidence among the consumers and also among the businesses, given the meltdown in property market and also a relatively volatile regulatory environment during the recent years. Policymakers have well recognized this bottleneck and started to take meaningful steps to restore confidence in the private sector, particularly in the internet and technology industries, which have undergone quite significant regulatory scrutiny since 2021. The government has also introduced target tax breaks and consumer incentives, eased credit conditions, and also provide direct physical support to key sectors like internet platforms and advanced manufacturing. These are real steps. President Xi's meeting with entrepreneurs, including Alibaba's very controversial founder Jack Ma, actually sent a quite important signal. China's private sector is critical to the economy and to the society, and policymakers is well aware of that because it contributes the majority of the country's GDP, tax revenue, technology innovation, and most importantly, employment. Now, I believe every one of us would have heard the news about DeepSeek. The emergence of DeepSeek, i.e. the AI startup company who's in China who's come up with open source and more affordable large language models, which are very good quality as well, it really marks another turning point. It reminds investors of the power of innovation on the ground in China. This is a long-term contention that our trust always held. China's shift towards high-end manufacturing and industrial innovations is not just about catching up, it's about leading as well. And in no small part, this is thanks to China's multi-decades of investment in new energy, transportation, and 5G infrastructure. Its hyper-adaptive and quite demanding domestic customer base, and its large pool of talents who can refine, reiterate, scale, and operationalize production innovation faster than anywhere else in the world. China graduates more than 40% of the world's STEM students every year, means science, technology, engineering, and mathematics. Now, Apple's CEO Tim Cook once said, if we are holding a tooling engineering conference in the US, we might not be able to fill in a room. But if in China you're holding such kind of engineering conference, they could fill several football fields. We came to China not for the low-cost labor anymore, but for the skills. So that's a good illustration of the grassroots momentum of innovation that is happening in China. For stock pickers, that's great news. Now, what does this all mean for the trust investment? We are genuinely seeing a growing number of very innovative and investment-worthy companies, and most of them are from the private sectors in China. In AI, for example, companies like DeepSeek are already pushing the boundaries. They have developed large language models on par with OpenAI's, but at a much lower cost. And that is a game changer, especially for local technology giants who are looking to embed smarter AI into their platforms. For example, Tencent, Pinduoduo, ByteDance are all well positioned to benefit from this wider adoption of AI. Now, we met Tencent's chief technology officer not too long ago in our office, and he shared with us Tencent's ambition of using WeChat to become the leading AI ecosystem in China. And he also shared with us more than 25 million small and medium-sized enterprises have already developed software under the utilization of AI within Tencent's ecosystem. And more than 25% of Tencent's codes internally are now written by AI. So we are seeing this giving a second leg of growth for platform companies getting back to innovating and growing again. The trust has significant exposures to China's domestic leading platform companies. Now, in manufacturing side, we're also seeing real global leadership as well. I'm sure some of you might have seen cars from BYD running on the UK roads already. BYD is now the world's largest EV manufacturer. And CATL, which is the world's largest battery producer, supply batteries to Tesla. And they aren't only national champions, they are global leaders and global competitors as well. Now, in semiconductors, the trust have been investing in the local substitution theme for quite some time. This is a trend accelerated by geopolitics because China still import majority of the chips they consume rather than manufacturing themselves. Then there's a very strong need from top down to bottom up that China needs to be more self-sufficient in making semiconductors themselves. We have two new holdings here. AMEC and Nora, for example, in the trust portfolio. Those are the companies are stepping up to fill the gaps in the semiconductor equipment manufacturing, which is left by US export controls. And Horizon Robotics is another newer holding in the portfolio, is increasingly becoming China's answer to NVIDIA in terms of chip designing, especially in the autonomous driving space. And then there is the consumer space, where the creativity is just as impressive. We mentioned about Meituan's on-demand service. Also, Luckin's online marketing and ordering model enable them to become the largest coffee chain in China. Now, the Generation Z is increasingly shaping the consumption market in China. Take PopMart, for example. You probably haven't heard about this company, but you might have seen a vibe called Labubu, which is a little toy character made by PopMart that has become a full-blown Gen Z icon on Instagram. It's not only hot and popular in China, but in London, you can see people lining up outside PopMart's Oxford Street store for the latest Labubu drop, like a Supreme sneaker release. It's very popular. The BBC even covered the craze as well. It's quirky, it's collectible, it's 100% viral. It's a great example of how Chinese brands are now also shaping global culture, not just catching up to it. Now, what ties all of this together is speed, scale, and innovation. These companies aren't just waiting to follow, they are racing ahead in their own lanes as well. Now, meanwhile, valuations in Chinese market remains compelling. Now, this is in stark contrast with big US technology companies. When you look at leading Chinese platform companies, the top 5 listed ones, they have, in aggregate, they have doubled their profit since 2021, but their total market cap has almost halved. So, in summary, we are at a more optimistic starting point for the asset class, where valuations remains underappreciated compared to the company's potential of growth. However, domestic policies have turned from headwinds to tailwinds. Innovations are vibrant, and global investors remain underexposed. When you look at China's contribution to global GDP and global GDP growth, it contributes almost 20%. But Chinese equity market, despite being the second largest stock market in the world, only takes about 3% of the global equity index, despite it contributes more than a third of the world's fastest growing companies. When we define faster growing companies, this is looking at the usually used MSCI All Country World Index, the companies there that are forecasted to grow their 3-year revenue by more than 20% per annum. Of those faster growing companies, more than a third are in China. And that's good news for long-term growth stock pickers because the hunting ground remains very rich. Now, coming back to the trust portfolio itself, the China Growth Trust offers exposures to some of the best growth companies in this pool in China to tap into this large opportunity. Despite a really difficult period since our taking on in end 2020, performance over the more recent year has turned around strongly and outperformed the index. This outperformance, to our pleasure, came from a broad range of stocks and industries rather than 1 or 2 single bets, including leading consumer brands, industrial companies, semiconductor companies, and internet platform companies. We have made 3 notable changes to the portfolio in the past year. First, we reduce our exposure to the companies that generate significant revenue from the US, This is under the backdrop of geopolitics, complications, etc. Examples here including the reductions to Anker. This is a consumer electronic brand which is very popular on Amazon. You probably can see President Donald Trump using their charging battery powers in interviews as well. And we also reduced Zhejiang Sanhua. This is a key supplier of heating solutions to Tesla. Now, both companies are still having exciting long-term opportunities, but we just think the geopolitics perhaps has lowered the scales of their potential upside and also our conviction on how tangible that is. Secondly, we added 2 companies that benefit from China's domestic growth. For example, we made significant additions to Meituan at the beginning of 2024, and the companies have delivered very strong growth in their core business, which is food delivery, but also travel and local services since then. We also bought a new holding in Haidilao, as I mentioned. This is a hot pot restaurant chain in China. They have a flagship shop in Piccadilly Circus in London as well, if you want to try. They are also benefiting from a gradual return to dining out among Chinese consumers after the pandemic. Now, overall, the portfolio retains its significant exposure to the Chinese platform companies, which we believe are all well positioned to benefit from a more attractive growth outlook domestically, and also from the integration of AI to their services. The last major change we made is we bought a number of new holdings in the semiconductor sector. This, as I mentioned earlier, we've seen increasing local substitution in this sector, accelerated by geopolitics. Names here including AMAX and Nora, as I mentioned. Those are semiconductor equipment manufacturers, as well as Horizon Robotics, which designs autonomous driving chips. Now, we won't deny that investing in China remains complex. To capitalize on the large opportunities that investors need a long-term investment horizon and be willing to accept periods of volatility. But that being said, the starting point today looks attractive. The portfolio itself reflects our genuine optimistic outlook at this juncture. The portfolio is expected to deliver faster earning growth than the index. It has also better quality, i.e. return to equity, than the index. We believe the potential rewards on offer today remains very attractive within the Baillie Gifford China Growth Trust. With that, I will hand over back to Joe, and we can have some interactive discussions on Q&A. Thank you very much.
Fantastic. Thank you, Qian. I think that was a really, really insightful update, both on the trust, but also what you and the team are seeing really driving companies from the ground up. So yeah, with that, let's jump into some questions. I think it makes sense to focus on a few trust specific and then broaden out into kind of the wider questions on China's outlook. So you mentioned that the Baillie Gifford China Growth Trust performed quite well over the last 12 months. And it's kind of really pulled ahead of the MSCI China All Share Index. Probably very difficult to kind of pinpoint one, but I think it would be really good to hear what you view as the area that's been perhaps the most important or the biggest significant driver behind that recovery in returns, and perhaps how you see that going forward. Do you see it as a lasting sign of recovery, or is it more of a tactical rally given the confluence of things that have happened over the last 12 months?
Yeah, I could completely understand with the background of the question, because investors have been quite disappointed by investing in emerging market and in China in general over the recent several years. You always have a quite long bear market and very short bull market, which is quite difficult to catch. We do think this time around it's more than just a short-term bounce. What we are seeing is perhaps the early phase of a more sustainable recovery in Chinese equities after a quite long period of underperformance. Why do we think like that? Let me break down firstly, the policy environment has changed significantly. Like I've mentioned it several times, but if you did have traveled to China over 2021, 2022, 2023, and last year, and talking with business and consumers on the ground, you can get a real feeling of that. The tone has changed significantly. Now, since September last year, Beijing has clearly shifted from being very cautious in terms of domestic policies, like tackling the property debt levels, etc., to actively supporting growth. We've seen very major stimulus measures like direct support for households, like changing old devices to new devices for your kitchen, for your living room, etc. We've seen infrastructure investment and also credit easing for businesses as well. It's, as I said, it's a more aggressive physical move we've seen since global financial crisis, and it's also well coordinated among different bureaus, different administrations, from the top central level to different different sector level industry organs, and also across different administrations like regional and provincial level. So it's a well coordinated concert from top down. Now, second, there has been a real change in the tone towards the private sector. This has been the biggest worry among international investors for some time. After a quite tough period of regulatory tightening, especially in the tech industry, the government is now clearly trying to rebuild the trust. The President Xi's meeting with entrepreneurs, including Jack Ma, the founder of Alibaba, like Meituan, Pinduoduo, like all of these, like DeepSeek founders as well, is a quite important signal. We are seeing platform companies to go back to innovating and growing again. Excuse me. And then the last one is like you really see consumer activities is picking up slowly but surely. As I said, excuse me. As I said about the travel visits to restaurants, to coffee, online food ordering, etc., all in high demand. Finally, the company fundamentals are improving as well. Our trust returns quite a lot over the past year, and a lot of them are driven by the operational growth of the companies as well. Many of our top holdings are showing quite strong earnings growth. Tencent, Pinduoduo, for example, they've doubled their profits in the past several years. So it's not only about a market bounce, it's more or less we think about it as a reset. It's a reset driven by re-engineering, AI and innovation-led growth, improving earnings, improving policy background. So that leads to a more positive outlook. We think this is perhaps the start of a more sustainable longer-term recovery, especially for strategies like ours that focus on high-end growth and innovation.
Fantastic. Now, I think there are quite a few factors there that seem supportive, and that's quite encouraging. We haven't seen as many supportive factors within China for quite some time, like you alluded to. So it certainly feels like it could be a sustained recovery, and I guess time will tell. One of the things, Qian, that you mentioned there was property, and you've seen Beijing's pro-growth stance, and a slight pickup and a recovery there. But clearly that part of the market, that sector, has weighed on sentiment towards China over the past few years quite heavily. And whilst I appreciate Baillie Gifford China Growth Trust has quite minimal exposure to real estate, are you seeing like genuine signs of recovery? And if so, it might be really good for the kind of listeners on the call just to understand what those recovery signs look like, because I think from the outside in, you hear that the sector's doing better, you hear it's recovering, but there's never really any, I guess, context behind that for investors looking outside in.
Yeah, so property market has been a very important growth engine for China's overall economy in the past 3 decades. But if you look at more recent several years, the proportion of its contribution to GDP growth has been dropping at a cliff. Now, part of it is general structural slowdown. There's only many houses you need, like you don't really need to live in three properties. You only live in one property one night. But part of that is really a sort of regulatory engineered slowdown, because it has to slow down from a very high pace, which is not sustainable. You see that in every major economy after a major property boom, and it's an engineered one. When I say that, because when you look at the property sales in China, the jump out of the cliff coincidence exactly the time when the regulation announced the 3 red lines restrictions from over leveraging, etc. as well. So it is a painful process. What matters mostly for us is the second order effect of wealth impact, because majority of the Chinese middle class household have a large portion of their wealth stored in property. If their properties are facing a drop in prices, that impact the marginal inclination to spend more. That's why at the very beginning, I've mentioned that Chinese household savings net increase is more than 10 trillion US dollar. That is a huge number. Just put it into context, it's 3 times of the UK GDP, 2 times of Japan GDP, and is also almost a doubling of the total retail sales before the pandemic in 2019. So people have saved what they could spend entirely for 2 years consecutively. So that's a very big pent up spending power behind it. Now, what are the signals we are looking for in terms of the recovery? Stabilization in property prices, which is quite, regulators are staying policymakers are staying very vigilant of that. They are willing to put a floor on it because they know that the repercussion impact of the broader economy is huge. We're not expecting any sort of like V-shaped rebound. It's probably a managed L shape. But to be honest, you don't need a V-shaped rebound to release gradually of the pent-up consumption power from that 10 trillion dollar that people have saved. One interesting signal we've seen recently is the incremental share of dispensable income that are devoted to savings has gradually declining recently. So that means like incrementally people are saving less than the past few years and willing to spend more. With the stimulus further kicking in, that probably have a bigger role to play here. You will never see a overnight turnaround in consumer confidence or recovery like just very quickly. It's a gradual, like I said, it's a gradual but steady pace, and we already seen that in experience-based consumption in travel, food, beverage, ordering, food delivery, etc. as well. So we don't really need a V-shaped recovery for a lot of our companies to do well. As long as there is a good floor there, we do think some of the consumer companies we have to have a good enough investment case to benefit from it.
Okay, fantastic. And I guess, yeah, when you look at it in the context of that pool of excess savings that could potentially trickle into the economy, that does give you some idea of the scope, particularly on those consumer-facing names over time and how they could push that growth forward. So that's very, very interesting. We've got a couple of questions on a bit of a similar topic here, so perhaps we approach this in 2 ways. One of the things about the Baillie Gifford China Growth Trust that could differentiate it is the access that it has to private companies. Now, Qian, if you could give us a bit of an insight, I think, into that process and why you think kind of a small allocation there is supportive, and then we can come on to then discuss that, the one current position that makes up the private space there, because that's where another question has come in about. So if we first just talk about the process, and then we'll drill down into the company specifics after.
Thank you. That's a very good question. And as you said, I mean, in Baillie Gifford, we mostly focus on long-term growth companies, and pretty much it doesn't matter whether it's a public listed company or a private company. Almost a third of the companies meetings we do with our Shanghai office locally are with private companies and founders. So the very good access and interaction, like very highly intensive interactions with the private companies founders, have two folds of purpose or benefits for us here. Number one is to build the knowledge base of the potentially good disruptive forces that come into a certain industry, to understand the founder's vision and insight early and build a good relationships with them early, so that by the time they become public companies, you have a good sort of understanding and knowledge base with them already. The second fold of the purpose is also a cross-check. I mean, a lot of the private companies not only represent the best disruptive forces in certain industry, but they could also be suppliers, customers, or competitors with the public companies that we own in a certain industry or even in the portfolio itself. So that is a tremendous additional resources of information over our research to understand a company's competitive edge more holistically. It doesn't make sense to invest in, for example, semiconductor companies, or even like consumer products, like phone-related products, on a listed company without understanding reasonably good about Huawei, which is a private company. So hope that makes sense. And Linda, who is the portfolio manager for the China Growth Trust, is going to have a 2-week trip in China at the beginning of July, and with a very long list of private companies that she was keen to talk with, including the robotics, autonomous driving, chip designers, a lot more on the innovation tech space. So we look forward to the feedback from that. As for the trust, we have now have one core holdings in private companies in Backdance, which has been quite strong investment case for that as well, for the trust as well. It has done quite impressively operationally. I mean, people may probably overseas heard a lot about that in TikTok. The saga of TikTok being bought by US or not, and Trump's announcement of delaying that execution of executive order by 30 days, 40 days, and 7 days, etc. But the core investment case for Backdance for us is actually its domestic engine, which is far, far bigger than its overseas franchise at the moment. So they are not only a social media company, short video company, but also very AI-driven e-commerce, etc. So there are many potential revenue streams that they can turn on with the broader adoption of AI, and especially, say, advertisement accuracy, like pushing to the right place, the enhanced algorithm, etc. Those are also new revenue streams or potential help to increase the profit margin. So that's the only private companies holding that we have in the trust. Not because that we're not seeing any other investment worthy holdings. We are actually doing a few in the pipeline, which may come at some point in the near future, but it's also a reflection of, we do see a good amount of return potential in the large public listed companies as well. Like I said, Tencent, Pinduoduo, etc. A lot of these platform companies, they are growing from big to bigger, and the AI is giving them the next leg of growth.
Okay, fantastic. And I guess on ByteDance, I think a lot of investors will have seen the US part of the business, the US revenue streams, and in that context, there's a bit of an above average Trump risk. You know, who knows what he's going to do from day to day, but it provides a bit more of a risk on that front. And appreciate there's obviously other revenue streams and they're very domestically focused, which is a big core reason why you hold that position. But do you think, or could you comment on the likelihood of that company being singled out for sanctions, perhaps?
I mean, we don't argue. We have more insights on what President Trump will do and etc. on whether they need to separate spin out TikTok to become a more of a maybe held by US entities just to spin it out.
Yeah.
From a pure investment perspective, it will be good if ByteDance can keep it, because it is obviously a potential large profit engine in the long term, but it wouldn't hurt the bottom line at all if it is forced to being sold, because their overseas business aren't particularly, I mean, US business aren't particularly profitable yet, so it's more of the revenue stream rather than the profit yet. So if it has to be spun out, it will be actually positive to ByteDance as a group's financial metrics. So again, I mean, when we think about our investment cases, mostly built on domestic, their domestic engines, and if they did being forced to spin out TikTok to a US entity, then that investment case for domestic growth remains.
Okay, brilliant. Thank you, Qian. And I think moving slightly outside of the stock specifics, we've had a question come in around listing relationships, and particularly how that works between the China stock market and the Hong Kong stock market. And I think there was a slide that you spoke about at the end there, slide 11, that kind of broke down listings. So perhaps it would be good for you just to kind of go into a bit of detail on that, and how, you know, the A shares and the other H shares kind of work together.
Yeah. So the starting point is the trust can invest in both.
Yeah.
And the reference index we use probably 50 H share and ADRs, and 50 in H share listed in Hong Kong. So we don't really mind where the best growth opportunities come from. When you look at historically, there is a difference in terms of sort of sector exposure between A and H. The H share market listed in Hong Kong are more dominated by large platform companies.
Yeah.
A lot of financial companies, state-owned enterprises, which we traditionally don't really invest in that much, and consumer brands. When you look at domestic A share listed companies, a large portion is in industrial companies, manufacturing companies, semiconductor companies, etc. So it's a bit more real stuff and technology, etc. And then when you think about H share, is more platform economies, consumers, financials, etc. Saying that, that gap is perhaps at the start of a long way of convergence in the next decades or so. You see Hong Kong's IPO market really picks up this year, giving like several folds of increase compared with previous years. And you see a lot of A share companies actually coming out to have a secondary listing in H share, like CATL, for example, did a recent one. Zhejiang Sanhua, as I mentioned, did a recent additional listing as well, and also some new consumer concept names as well. So we don't really have a structural bias of one towards another, but we do sometimes look at the potential valuation difference between the two. If there's a cheaper way to access a good growth company from the H share line, and the H share line will probably take advantage of that, but we wouldn't trade in and out to time that, because that's just not part of our philosophy. But our view is in the long term, these two will perhaps converge in the very long time horizon.
Well, that's very helpful. Thank you for going over that. And I think kind of shifting a little bit more now to the broader market, we've got time for a couple questions on that. Thoughts on currency? You know, I think with the dollar weakening, that has typically, you know, made investors think, well, emerging markets will benefit. But in your mind, Qian, what might this mean for China with the dollar weakening? Appreciate the portfolio is domestically focused, but yeah, it'd be interesting to get your thoughts on that.
A very simple formula is like a weaker dollar is generally good for emerging market, and probably China included, but not to perhaps the impact is not as significant as other smaller emerging countries which relying on dollar funding or dollar trade more. As you said, the majority of the revenues of the trust holdings are domestically generated, so it doesn't really impact their operations that much. But thinking about that in a broader framework and a longer time horizon framework, it does have implications on sort of the world order, because over the past 30 to 40 years, majority of the times trades is matching the consumers in the West, in developed market, with producers in emerging markets, especially in China. So it's like China and emerging market manufacturers, and it sells to people consumers in America and in US and Europe to consume. And that means if the most of the trades are with the West, that means the majority of the trades are domestic. Makes sense to denominate that at the dollar or euro or hard currencies. But when you look at the world trade dynamics nowadays, increasingly emerging markets are trading more with each other. Especially China is trading a lot more with global south, i.e. emerging markets. When you look at listed Chinese companies are now selling more to the emerging markets than to developed markets. I mean, China's trades with ASEAN countries is now bigger than China's trade with US, and it's bigger than how much US trade with Europe. That has profound implications in the long term, because if you are trading with your emerging market neighbors, it doesn't have to be denominated in a hard currency. It can be done in renminbi, it can be done in Indian rupee, it can be done in Brazilian reais, etc. And then the proceed from that can be recycled more to local currency denominated assets within emerging market, or Chinese government bonds, or Chinese equities. Because in the past, when dollar was the major denominating currency in trades, it makes sense to keep the dollars throughout the supply chain and to recycle those proceeds to US treasuries or buying Premier League football clubs, etc. But now if you're trading more and more with your emerging market neighbors, you use a lot more non-hard currency, like EM local currencies, then it's more likely those proceeds are being recycled back to domestic currencies. Like you see the surge of Taiwan dollar and Korean won recently at the very beginning. So perhaps more impact on other emerging markets than China, but it's not a bad news. It's a supportive news for most of the emerging market investing.
Okay, great. And I think we can squeeze one more in, I think, Qian, if you don't mind, just on the regulatory crackdown. You know, we've seen in the past IPOs pulled, tech giants have been fined, and you know, a lot of crackdown within certain sectors like education. And I think that left investors with a bit of a sense of unease that rules could perhaps change overnight. And that's one of the things that, you know, we're hearing that's quite hard to kind of push past. Do you think, given the supportive environment that you've discussed on this webinar, that that's still a concern for investors? And and perhaps that any new regulatory crackdowns can come into play and disrupt more, or are we shifting away from this now?
Yeah, I think it's understandable, like with all the media reports, like investors who are not spending majority of the time looking at China, seeing it's a very very dramatic move and very generic conclusion is whether a regulatory crackdown is on and off, but in reality, it's a lot of nuance within it. I mean, within the China Trust, we've never invested in the education sector. And then one of the key things we ask ourselves is, in our research process in a particular company, the first question we ask is, how does this company's business contribute to or benefit from China's societal development? It's quite important. But when you think about education sector, you can argue, is that a public goods or not, right? So you would have different regulatory stance and different level of state participant sort of purpose behind different sectors. I mean, the policymakers wouldn't want to have a very big say in a beer company or a toy company. But if you are a healthcare business or a education business, that is, you can argue whether is that public goods or not. Is overcomputation really to a point that is detrimental to the inequality of the society and the economy, which arguably every developed country also face with. So put that aside, I think that the understanding of the different levels of state involvement in different business is quite important, and we don't want to apply for a brushed view of everything equal. So the differentiation and selection is very important within that. And then secondly, I think, as I said, we need to remember how important the private sector is to China. I think a lot of investors are probably thinking China is very top-down dominated, still very driven by state-owned enterprises, but it's not. Private companies are the majority of the blood in the economic system, and especially like more than 90% of the urban jobs are hired by private sectors. So it's policymakers understand it's important and critical to keep the private sector vibrant. One way to understand the regulatory crackdown is, we call it a regulatory crackdown. But if you look at the problem they're trying to solve, is not very different as the Western regulators. They are trying to deal with the antitrust issue, deal with the unfair competitives, like you can only choose one of the two deliveries from the market if you're a restaurant. So customers was left with no choice. So that's a lot of these things are commonly faced problems in all major capital markets, not only China, but the problem is because of China's top-down governance system, it was executed very, very poorly, which has caused a lot of chaotics and loss of trust and confidence within the business community. The unwritten narratives is perhaps policymakers have learned that they've done a poor job.
Yep.
They will never come back openly say that, but the more recent stance where you see from the top policy voices all pointed towards a renewed support to private sector is because private sector is very important. But again, another layer of active differentiation among different type of business when doing your stock picking is very important.
Brilliant. Well, Qian, thank you again for that. I think that was a really helpful session, detailing the trust, but also your broader views and outlooks on the economy, and some insightful answers to our audience questions as well. So thank you very much. For those wanting to explore a bit further, then Qian and the team at Baillie Gifford publish a range of really excellent materials on both the trust, but also broader market insights on their website. We at Kepler Trust Intelligence have also just released a full research note on the trust, highlighting why it could offer a compelling route to access China's long-term growth story. So do take a look at that as well. I just wanted to say a big thank you to you, Qian, for providing that update and the outlook on China as well. It's been really fantastic to have you on.
Thank you for your support on the China Growth Trust. Thank you, everyone. Have a good day.
Thank you, Qian. And yes, agreed. Thank you so much for everyone who's dialed in today. And with that, take care and bye-bye for now.